Good day, everyone, and thank you for joining the call today for Japan Display earnings call. Today's speakers are Scott Callon, our Chairman and CEO, and Akihito Okochi, our Chief Financial Officer. Now, Scott Callon will start the presentation with an overview of the first quarter. Please.
Thank you, everybody. I'm Scott Callon. We really appreciate your time. Thank you for joining. So I'll be going through kind of the overview of the first quarter, and then Okochi-san, who is the CFO, will go into the financial details. So let's jump ahead to page. Thank you. So look, the background to everything that we're doing is what we're all experiencing globally. We are operating on COVID, which is really, really hard. We've got a global supply chain, and we're running factories, and we need to keep our people safe, and we need to deliver product to our customers. And these are challenges that are deep challenges for our supplier partners and for our customers also. And that is something that I think every business operating globally is experiencing. The first bullet point speaks to something that is specific to most every global manufacturer, including ourselves. On top of COVID, we're dealing with a semiconductor shortage that is absolutely devastating. It is an extraordinarily difficult operating environment because demand has surged and there's really no ability to provide enough supply. So everyone's on allocation, and we're working with our customers and suppliers, and we are blessed with really world-class customers and world-class suppliers. And so continues to be a very tight coordination on a daily basis. What's available? When can we ship it? And it's just really, really hard. It is extraordinarily difficult and I would say devastating environments to be operating in. And devastating means that we can ship everything that in other words, we have customers for everything that is shippable. So the demand side is extraordinarily strong. It's the supply side. Can we get enough parts? In our case, it's display driver ICs that are the critical item in order to deliver to our customers. Having said that, I mean, it's working. We have worked very, very hard, as I said, with our customers and our supplier partners, and been able to substantially reduce the risk of production and order declines. We have, in one case, and we're looking at several others, signed long-term stable supply agreements, and so things are progressing actually very, very well. But it's a very difficult. Second bullet point speaks to what we need to continue to do, which is further cut our fixed and variable costs, which we have done. So our operating loss for the quarter came in significantly below forecast, which is a good thing. We were looking at what we thought 8.8 billion yen operating loss. We came at a 5.9 billion yen, so that's a 2.9 billion yen improvement. I'll speak to later on to the agreement that we have made to sell a Taiwanese manufacturing subsidiary to a world-class Taiwanese EMS named Wistron. The goal there is to strengthen our competitiveness and drive growth. And again, I'll give you some details on that. Next bullet point. So I'm going through kind of some of the key things that we did during the quarter. This actually was a transaction we did last Friday, so it's after the quarter's close. So it's not showing up in the current financial statements. But we took in an additional 16.6 billion yen of capital from Ichigo. That increases our shareholder equity ratio from 14.3%, which shows up on the balance sheet that you see in our current Q1 financials, to over 20%. And finally, we got notification from the TSE, Tokyo Stock Exchange, last month that we qualify for the prime market. Of course, if we qualify, we're going to go into the prime market. So we're in the process of progressing that. Next page, please. I told you the operating environment is difficult, if not devastating, which is true. Nonetheless, as I also said, we made a lot of progress. So we actually are doing an upward revision of our forecast. The three drivers of that are one, again, as I said, we've made substantial progress in reducing the impact of the semiconductor shortage. So, the full year forecast that was originally 254 billion yen was conservative, but it also had a certain amount of downside risk on semiconductor parts not being available. We made a lot of progress, so we're upgrading 10.2%. The other driver of this upgrade is substantial increase in customer demand from major customer, U.S. And finally, to some extent, we're reflecting higher JDI product pricing. So with 280 billion, we think this is not only meetable but beatable. So our goal would be to come above this. But for the moment, we're raising our forecast by 10%. Next page, please. Just to give you some sense of what's going on in the different product segments that we operate in. And there's a very big difference with what's happening for us in the LCD smartphone space in the US and Europe and every other product category. So this is the weather forecast, which is actually used a fair amount in Japan, and we're a Japanese company, to describe kind of what the state of being is in industries and segments. So we're adopting that for this presentation. Hopefully you like the pictures. So mobile. Look, is something is a long-term trend where because this is an LCD smartphone segment for us, we expect this to remain cloudy and there will be a secular decline in our shipment of LCD smartphones, which we're going to replace with OLED and automotive and non-mobile. So anyway, that stays cloudy, both current and forecast. Turning to mobile China, and that's overwhelmingly China, over 90% China, very strong demand. And so that actually gets kind of a cloud plus sun. So it's either cloud plus sun or the cloudy becoming sunny. The reason why it remains kind of cloudy, though, is the pricing, as you know, on Chinese shipping smartphone displays to Chinese manufacturers. It's very, very tight. This was a business that was unprofitable. It's turned kind of to be barely profitable. So that's a very substantial and nice improvement. But this is not going to be a place where we drive a lot of earnings going forward. Nonetheless, very strong demand. And because of the tightness in global markets, and because we can ship, in quantity and at quality that's the best in the world, this is a business that we're able to do productively. So it does, it's a business we're happy to have, but it's not going to be a big earnings driver. Turning to automotive, the issue here is, so we say this cloudy to going to cloudy plus sun. It would go to sun, just like non-mobile, sunny. Happy times for all of us, except for the semiconductor shortage, which continues to be, very, very impactful for auto. It's a very hard situation. And in that context, the good news is we continue to have overwhelmingly dominant market share on the high end. We've got a very robust new order book. If we get through, when we get through, and we think we're going to see substantial improvement, at least in our supply chain on semiconductors by the fall. Specifically, we did a major transaction with our most important driver IC supplier that will get product from their factory to us in September, and so that means we're shipping to customers in October and November. So we'll see a very, very big change then. But for the moment, automotive continues to be very impacted by the semiconductor shortage. It's a way of saying right now, in both automotive and non-mobile, which are substantial growth areas for us, we are not shipping as much as we can because of a shortage of parts. And then finally, turning to non-mobile, that is the most exciting, most impressive, and most rapidly growing area for us. So it goes from cloudy to full-on sun. This might even be worth several suns. We're both seeing strong demand for wearables in our OLED product, which we expect to continue to grow. But the biggest driver at the moment, it appears to be going forward, is an ultra high resolution LCD VR, so virtual reality. The advantage that we have in the VR space is it's not only ultra high resolution, so it's a very, very high technical requirement to meet. It's that you're wearing these goggles that are right in front of your face. And so, I mean, literally inches from your eyes. And if there's a quality problem, it's incredibly noticeable. So you need to be able to ship to an ultra high resolution and ultra high quality. And it appears to be the case that we are the only firm in the world that is able to do that at scale. And other firms are either, it's too hard to get kind of both ultra high resolution and quality at the same time, so their yields are way too low, or they can't even get to ultra high resolution in the first place. So we're going to see over 50% growth in this business, in the VR business this year. We expect 50 to 100% growth, possibly compounded going forward. A very, very important driver for us going forward in profitability. And the reason is because, I mean, the other thing is that this is a relatively small market. And so we fully expect the market is going to continue to grow rapidly. And, you know, at the end of the day, if you produce a great product and so do all your competitors, there's really no advantage, no ability to price for value. And because we have distinct capabilities that appear to be unmatched, this is something that we think is going to be very important to us going forward. Next page, please. I mentioned the sale of KOE that we announced last month on July 8th. The goal of this is to take an in-house, so this is a back-end module plant in Taiwan, and hand it over to Wistron, which is an extraordinarily capable Taiwanese EMS. We think they can drive higher competitiveness by getting better pricing for us. So we think this is kind of a win-win-win-win-win. I mean, we shed assets, we can fix costs, variable costs, we increase our operating flexibility, our ability to respond quickly to changes in market environment, our core earnings power, our capital efficiency. We get some money out of it too, which we're happy to have. But really, it's the driver of this is a strategic initiative for us to, one, improve the competitiveness through better pricing in automotive and industrial businesses, which are core to us, and also to partner with Wistron, which we think is a partner, has been EMS partner for us for years, and we think have the ability to grow, to do some new growth together. Next page. I mentioned last Friday, we got additional 16.6 billion yen from Ichigo. That takes our shareholder equity ratio over 20%. There's an exercise amount of 19 billion, which we also fully expect to get. Next page. And this is who we are and what we do. It's our mission. It's something that is absolutely fundamental to what we need to do. We are a personal tech company. What we do, and by personal, when we're shipping displays for autos, and we're shipping smartphones, and we're doing wearables, and we're doing VR. I mean, these are not for autos; they're for the people in the autos. So, we are very involved in the daily lives of literally hundreds of millions of consumers all over the world. What we do is meaningful. Displays are fundamental technology for modern life. For us to be world class in this area is extraordinarily important. And for us to contribute to the world and society and by doing this well and doing it ethically is incredibly important. So everything we're doing now is creating the basis for a strong foundation. Profitability, we're continuing to keep our EBITDA turning positive target for the fourth quarter. And I will now turn it over to our CFO, Okochi, to go through the details. Thank you, everybody.
Thank you, Scott-san. So I will explain about the Akihito financials. The first the financial overview. First quarter, sales decreased to 22 billion yen year-on-year basis. The result is 66 billion. That was mainly because by mobile demand decrease, as Scott and myself mentioned earlier. Semiconductor shortage caused minus 8.8 billion yen, as you see on the below chart. Comparing to our forecast on May 14th, sales increased over 22 billion yen. I explained the details of the sales and operating income after next pages. Regarding the P&L, cost reduction, please go back to the original page. Yes, thank you. Regarding P&L, cost reduction made gross profit 1.4 billion yen, which 0.4 billion yen increased, and operating loss was 5.9 billion yen, which 1.1 billion yen increased year-on-year basis, even though sales decreased a lot. Except for negative effect by a semiconductor shortage, we could have expected 4.2 billion yen operating income improvement. Comparing to our focus on May 14th, operating income improved 2.9 billion yen. Ordinary loss 2.4 billion yen improved, and net loss 9.3 billion yen improved. There are no loss for Hudson plant assets preservation costs and business improvement costs respectively last year. EBITDA became minus 0.5 billion yen as depreciation progressed. Except for negative effect by a semiconductor shortage, we could have expected 2.6 billion EBITDA improvement. Next slide, please. Sales by product. Firstly, mobile business. As we had explained, mobile sales has been decreasing since the main customer shifted from LCD to OLED for their smartphone display. Comparing to last fiscal year, sales from the main customer became half, 55.4 billion yen to 21.4 billion yen. That slightly increased quarter-on-quarter basis. China mobile business has been good and increased 8.7 billion yen, which was 3.3 billion yen increase comparing to our focus on May 14th. Next, old business. It's received a serious damage by semiconductor shortage, although 2.5 billion yen shortage from our own case from our focus on May 14th, the result became a large increase year-on-year basis. Lastly, no mobile business. Wearable OLED displays to our main customer and ultra high resolution LCD for VR are in good, and those sales increase both year-on-year and quarter-on-quarter basis. Especially VR has been good and increased 2.1 billion yen comparing to our focus on May 14th. These factors made the mobile business ratio 46%. Its volatility is very high, but the ratio is going to be smaller going forward. On the other hand, automotive and non-mobile, which volatility are low, the ratio is getting bigger, and we will diverse our business portfolio going forward. Next slide, please. This is the operating income changing factors from last year to this quarter. 2020 first quarter sales was 88 billion and operating loss was 7 billion yen. And this quarter sales was 66 billion yen and operating loss was 5.9 billion yen. There are four factors for this result. First, sales decrease and change of product mix caused 3.3 billion yen worse. However, we implemented manufacturing fixed costs 1.7 billion yen cost reduction and SG&A 0.8 billion yen reduction, totaling 2.5 billion yen reduction. The factors are depreciation decreased by impairment, improvement, and any other cost reductions. These made total 1.3 billion yen cost reduction. As a result, sales substantially decreased, but operating loss improved 1.1 billion yen. Next slide, please. This is the revised full-year sales focus, as Scott explained earlier. We revised 21 sales as 280 billion yen, which is 10.2% increase compared to our focus on May 14th. The main factor is the increase of the mobile smartphone LCD for Europe and US customer, and smartphone LCD for Chinese customer, and automotive are also increasing. The chart below is the comparison with the 2020 actuals. As we had explained at the previous earnings release, so I'll skip the details. That's just done. Next slide, please. This is the last slide. Next slide, please. Thank you. Second quarter forecast. The above chart is the one which shows the total of first quarter actual and the second quarter forecast. And the below chart is the one which shows only second quarter forecast. As for first half, the sales will be 134 billion yen, and that is the 33 decrease year-on-year base. The main factor is the sales of our main customer decreasing, which has been continuing last year. However, all other product categories, such as the mobile for Chinese, 22% plus, automotive, 18% plus, non-mobile, like wearable OLED and ultra high resolution for VR, 11% plus. We expect strong demand here. Except for the damage of the second by the semiconductor shortage, the focus will be 150 billion yen, decreasing the 25% year-on-year basis. The P&L operating loss will increase to 13.9 billion yen, mainly due to the sales drop. Except for the damage by semiconductor shortage, the amount will be 7.9 billion yen. That means a 2 billion yen operating loss improvement. As for quarter two, the details are mentioned on the chart on the right-hand side. The trend is the same as first half, as explained earlier. Operating loss will increase to 8 billion yen due to the sales decrease. However, semiconductor price increase will be passed to the sales price from quarter three and onward. And our fourth quarter goal is EBITDA, positive EBITDA remains unchanged. This is the end of our presentation. Thank you for listening.
Then we will close the conference now. Please feel free to contact Japan Display Investor Relations if you come up with any questions later. Thank you very much for joining the call today. Thank you.
Everybody, thank you very much. Take care.
Thank you very much.